Well, good afternoon. Happy Friday, May 2nd. Mark Milam here, your mortgage professional, talking to you from my dining room since my office is going through a little bit of a home renovation. Let's get right to it. Not a bad week in terms of economic data that should be friendly for mortgage interest rates, but we're closing out the week on kind of a dud. We got a non-farm payroll, this number that I'm going to discount in just a second, but let's first go back to Wednesday, April the 30th, when we got the personal consumption expenditure. This is the Fed's favorite measure of inflation. Came in at 2.3%. That's really low. The Fed's target is 2%. And we all know there's a lag in these numbers. So we're already at 2.3. I think in any other circumstance, the Fed would already be cutting. But because of the albatross hanging over us here, these tariffs on China particularly, I think the Fed is waiting to see how the tariffs are going to impact the economy. And for that reason, holding off on any Fed fund rate cut. I don't think we're going to see one on May the 7th. That's the next scheduled meeting. I do think we'll see a quarter point rate cut coming up in June, but obviously we're a good ways away from that at the time being. Today was the interesting report. This is the non-farm payrolls number. We posted 177,000 jobs created. That beat expectations. Part of the reason why we've seen mortgage-backed securities sell off, interest rates worsen on the day. But you can see these numbers go through two rounds of revisions, the green bar being the revisions, and March and February were both revised down again from the headline number that appeared for each of those months. So in February, we actually added 102,000 jobs. We were originally told it was 151. And then in March, we added 185. We were originally told it was over 220,000. So who's to say that this 177 number will hold up? In fact, I expect it to be revised lower next month and then probably lower again in the subsequent month. And for that reason, I just don't put a lot of credence into these figures. Let's move this out of the way and talk about one other thing. And this is Fannie Mae's profitability in Q1 of 2025. So on Wednesday, April 30th, Fannie Mae posted a $3.7 billion profit for the first quarter of 2023. That's right, billion with a B, and it's net income after all expenses. So $3.7 billion in the first quarter of 2025. Fannie Mae's net worth creeping up now on $100 billion in net worth for Fannie Mae. And what's fascinating is that we're posting these kind of profits with very much reduced volume compared to normal circumstances. The housing industry has been in a recession now for the past 3 years. So it's fascinating to see that Fannie is still posting this level of profitability, but that doesn't seem to be good enough for Director Pulte. Fannie Mae Chairman Bill Pulte declared that the company's first quarter earnings were not sufficient. He wants to trim the fat at Fannie Mae to help drive up quarterly earnings. This is because Q1 of 2024 had over $4 billion in net income, and Q1 2025 dropped to 3.7. Interesting that our discussions here would be around trimming fat and reducing cost at Fannie Mae versus driving up the number of transactions, which would in turn drive up the amount of net income and making housing perhaps more affordable. And that's one of the gripes that I have certainly with the GSEs, is that we've really done nothing to address heavy-handed loan level price adjustments that, while they might contribute to profitability, make everything about housing more expensive, and they impact affordability for most Americans when they go out there to buy a home. And these loan level price adjustments have been amended time after time after time since 2008 when they were first introduced. And now we find ourselves in a climate in 2025 where so much is being paid towards Fannie Mae when you originate a conforming conventional loan that contributes to that 3.7 billion in net income, and it's impacting home ownership affordability in a negative manner. Not to let FHA off the hook, FHA's capital reserve ratio is supposed to be about 2% per Congress. That's what Congress has stated is the statutory minimum for FHA's Mutual Mortgage Insurance Fund. And that fund now sits at over 11%. As of the writing of this article back in November, it was 10.8. It's now 11%. It's 500% larger than required, yet we don't see anything out of FHA or out of the administration in the White House about reducing the FHA mortgage insurance premiums. It says Trump appears unlikely to reduce these premiums, though the NBA has been calling for it. Listen, FHA mortgage insurance, right now, it runs about 0.55% for the annual premium. Well, if we're at 500% of what's required by Congress, could we not trim that a little bit? Could we not get that down maybe to 0.35%? Could we not make mortgage insurance cancelable for FHA loans, especially once you've reached 20% equity in the property? These are all ideas or items that seem to be low-hanging fruit, and it's tough to take the GSEs and it's tough to take FHA seriously when we won't address simple things like loan level price adjustments or reducing annual mortgage insurance premium when we're 500% capitalized with the Mutual Mortgage Insurance Fund. We'll keep calling for improvements in these areas. In the meantime, if I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at highlandmtg.com.